Thank you very much, ladies and gentlemen. It's always a pleasure to be here. It's always a great pleasure. But I have to say, when Lynn said he's been coming here for 10 years, I suddenly started to feel very, very old, La. So, especially with no hair, La. So let's hope the message is still fresh, because we've got an awful lot to talk about today, because we really are in a situation that we've never been in before. And of course, a lot of this is to do with liquidity. And it is forcing investments into areas where they don't want to go. But nevertheless, there are still stories in there. We're not in a car that's got no driver at the wheel. We've definitely got investment opportunities out there, and that's what we're going to focus on today. But we'll start off by just doing a quick look at where we actually are. We all know for the last year the focus has been on developed markets, and there's a lot of firms out there now still saying you should go into the developed markets. You should go into Europe, for example. We're hearing a lot of that. Now, our take is these markets are not over their rallies yet, but you can see that they're a long way through their rallies. They are mature rallies. And so we're saying one should be starting to look elsewhere, because there is value elsewhere. It's just a matter of when that's going to be triggered. And of course, some of that value is in the emerging markets, some of the emerging markets. And we'll find out which ones in a minute. But at the same time, what's making this very complex is that there's still mileage in credits. And this is because of quantitative easing. And we're going to talk a bit about that in a minute. So normally, at this stage of the economic cycle, we would be saying to clients, look, you should be switching out of bonds and you should be going into equities. Have a look at this. You see what I mean? This is the business cycle. And here, growth is slowing down. So in here, we'd go in for bonds. Here, growth is starting to pick up again. So you'd go in for stocks, equities. Growth accelerates. Inflation starts to pick up. People start to get into commodities. Then everything starts to slow down again. You go into cash. And then as things are starting to slow down, and bond yields look attractive, you go into bonds, etc. And then the cycle repeats itself. Now where we are now, we think, is round about there. But it's very, very long. Normally this would be a fairly short period, but this time it's being extended because the recoveries, while there, are weak. And we've still got all of this cash sitting around. And this is causing an investment dilemma. Let me show you some of the questions that we are getting from some of our retail clients around the region. So these are not me, these are not my questions, these are the questions that investors are asking us. The first one, an extremely good question. Everybody saw what happened to bonds last year on tapering fears. Bonds suddenly got very, very volatile. And one client, in fact not one, but the first client that asked me this was actually in the Philippines, in Cebu. And he put up his hand and he said, look, I understand that QE is going to go on for a long time. I understand that interest rates are going to remain low for a long time. And I understand that bonds could become more volatile. So my question is the return on my bonds going to justify the volatility? Because if it isn't, maybe he should be getting that return via high dividend income funds. So this is the kind of question that we're getting. And of course, it then comes down to, why are you buying the investment class that you are buying? If you're really going to buy income and interest rates remain low for a long time, which we think they will, then of course maybe you should be sticking with bonds for longer than you normally would in this stage of the cycle. Apart from bonds and income, how much equity risk should I take at this stage? We all know the bond story is going to come to an end one day, but as I say, that may not be for many years yet. But we know at the same time that there is a slow recovery there. So how much and how quickly do I get into equities? And then after that, what equities? Do I go into the equities that are exposed in the stock markets that are exposed to growth? Do I remain in safe equities? And of course, the big question for this year is going to be, well, when do I start switching out of the developed markets into the emerging markets? And I don't even think that's the right question, to be honest, as we will see in a minute. So this is the environment in which we're living, and this is the kind of question that investors are asking us. So let's have a look and see what the drivers are. And the first driver, of course, is liquidity. And, of course, quantitative easing. And we're going to hear an awful lot about this over the next couple of months as people speculate, what is the Fed doing? But how much money is actually going into the system? We talk about liquidity, but how big is it? Is it big, small? How big is it? And that's what we tried to do on this chart. We've got a chart which shows the higher the number, then the more liquidity is being injected into the system by the central banks. And if you look at what the Fed has been doing, wow. That is the relative money that the Fed has been pushing into the system. And here we see how much and how aggressive it got when the crisis first hit. But if you look over the last year, the Fed has continued to pump money into the system at $85 billion a month. Now, what happened last May was a fire drill, because we all know when interest rates start to rise, we've got to get out of bonds. The question is, are interest rates going to rise soon? And people are saying when the Fed tapers, interest rates will rise. Not necessarily true. In fact, probably not true. Probably not true. Tapering just means that money, the injections, are at a slower rate. That's all it means. So think of it this way. You go in, you've done a good job, you've done a good year's work, and your boss says to you, look, you've done such a great job, I'm going to give you $70 billion a month. And you go, what? 70 billion a month? I want 85 billion. 70 billion a month is still a lot of money. Money will continue to grow like this. Now, that is not the same, tapering is not the same as this, which is money coming out of the system. When that happens, for sure, we will see interest rates rise. But people want to preempt this because they know that bonds are expensive historically. But if interest rates remain low for longer than people expect, then we could see bond yields and bonds still remaining strong for much longer than people expect. Now, I know you're all going to say, well, how long? So this is my personal view. I think the Fed is going to be very, very, very lucky to raise rates within the next 3 to 4 years. I think it's very, very difficult. That's my personal view. But you think about it. If interest rates remain that low, that long, even a 3% yield on treasuries, if inflation is still 2%, if it gets that high in the States, that's still a very good real return. And so you see, it comes back to the original question. We just can't throw bonds away at this stage in the cycle. There's still more mileage, but it will be more volatile. And so when we're looking at this, we have to decide what volatility do we want. If we've got volatile markets, maybe we should be going into equities and equity income type products. This is only half the story. Over the last year, another liquidity player has come onto the stage. And of course, that liquidity player is Japan. And when you look at the amount of liquidity relative that the Japanese central bank is producing, it may come as a surprise, because you have a look. That is how much the Japanese are pumping into the system. It's a lot, isn't it? Relatively. And if you think about this, if the Fed starts to taper and the Japanese are only beginning their QE, which they are, then the liquidity in the system will continue to build, but where that money goes will reflect Japanese investor preferences rather than US investor preferences. And at the moment, we do know that the Japanese are still buying US treasuries. So the picture, just because treasuries are expensive, doesn't mean to say that the story is over yet. Now, of course, there's other central banks out there pumping money into the system, or not. So the Eurobank is actually pulling money out as people repay the loans that they borrowed over the crisis. The Bank of England is about steady. Won't show those, but if we look at the total result, at the end of the day, you can see that the liquidity in the system is still continuing to rise. And it will rise next year. And so, of course, with rising liquidity will come rising volatility. Well, if we know it's going to continue, how much liquidity is out there? Let's have a look at this. Now, this is a chart some of you may have seen before, that I use it quite frequently. It's the free liquidity in the system, in the monetary system globally, that can go into investment. It's the money that's being created by the world's central banks over and above that money needed to fund economic growth and inflation. The higher, the more money being created. Oopsie. When SARS first hit, and you can remember, central banks pumped money into the system, that's how much money they pumped in. And that fueled the May 2003 rallies. Just because they pump money into the system doesn't mean to say it's got to go into equities. It might go into bonds, might go into property, might go into commodities. But eventually, this fueled initially a bond rally, and then you got the huge switch from bonds into equities. Of course, the money that was pumped in when the crisis first hit was huge. That's when the Fed really came in and pumped money in. And you can see the huge injection of money that came into the market in 2008. In 2009, everybody said, wow, where did the stock market rally come from? Well, it came from that. All of that money pumped into the system. And look at where we are today. We're not as high as the others, but it's much, much bigger. There's an awful lot of liquidity out there. You see it in Hong Kong and Singapore and all over Asia, with property prices going through the roof. You see it in the US with the stock market booming. You see it all over the place. There is a huge pool of liquidity out there. And so that, we think, is going to continue fueling financial markets this year. So the challenge of the fund manager is to balance up the volatility of the liquidity that's going to result as people chase value, and identifying quickly where that value actually lies. And I think there's some very good stories out there. But on top of this, there is another big factor at play. And that's this. Here's the dividend redemption yield of bonds. And we all know that we buy bonds for income, but over the last 30 years or so, we've been buying bonds not just for income, but for also a little bit of growth. Wow, that sounds good. Good income and a bit of capital gain. Wow. Problem is, that game's coming to an end, because if it's not this year, if it's not next year, it'll be sometime when interest rates do start to pick up again. Okay, so fine, so good. What about equities? Well, we've been buying equities for the last 30 years for a little bit of income, dividend yield of around 2%, 2 to 2.5%, and a lot of growth. So we were buying bonds for income and a bit of growth. We were buying equities for income, for growth, and a bit of income. But look at the problem. Look at where we are now. The yield, the income that I can get from both my bonds in general and my equities in general is the same or very similar. So as an investor, I really have to decide, do I want my income or do I want capital growth? And a lot of bondholders this year could easily say, hey, I don't really want the income, I wanted the growth. And so you could see the switch into a dividend income type product continuing. Now, dividend income and income type products have gone off the radar a little bit because they were all the rage at the beginning of this year, they were all the rage last year, but there's still a lot of mileage in these. All depends what the individual investor wants and how they want to play that risk and return. So, that's enough about liquidity. I'm sure you've got the picture. Underpinning all of this, of course, is growth. And we've seen a lot of downgrades over the year for Asia. We've seen a few upgrades for the developed economies for 2013. But when we look at 2014, those forecasts have remained relatively stable so far. And I don't know if you can see them there, but I know you all know what they are. Asian growth looks great. And US and developed market growth looks okay. So you've got to ask yourself, look, if developed markets are looking, if the growth is just looking okay-ish, and we've got great growth in Asia, why are we hearing on the TV, in the newspapers, in your newspapers, that people are moving away from Asia and emerging markets to the developed markets? Good question. Why indeed? Let's have a look and see if we can get an answer to this. And the answer, I think, lies in the purchasing managers' indices. And here we've got the purchasing managers' indices. I'm sure you're all familiar with those. 50%, anything above 50%, it's growth, looking good. Anything below 50%, no growth, or slower growth, bad. Now, the purchasing managers' indices are a measure of confidence. They're not the actual data, it's the confidence factor. And let's have a look, and I know you know this, but humour me. I know you know this. When we look at the PMI for the States, you look at it and look how it has soared. Wow! Wow! Doesn't this look good? The PMI Purchasing Managers Index, the forerunner of growth, it's going up like this. Wow! Even though US growth is slow, everybody's getting pumped up about the US. Wow! What about Japan? Wow! Yeah, it was way down here. Look at it, suddenly it's way over 50. Wow! Growth in Japan. Even though weak is growth is weak. What about Europe? Holy cow! From zero to hero. No wonder people are going and saying, buy Europe, buy Europe, buy Europe. Well, I mean, if these are the developed economies where growth is really weak, it's got to be looking damn good in Asia, right? Well, let's have a look at China as a proxy. Boring. Boring. And you see, I think that's what happened this year. You see, you had investors were not chasing developed markets. They were not chasing emerging markets. They were chasing growth. And we saw that even though growth was low in the developed markets, it was starting to improve. Even though growth was high in the emerging markets, and Asia in particular was high, it was slowly being downgraded. At the beginning of the year, in fact a year ago, the developed markets were cheap. If they're no longer cheap today, and investors are still chasing growth, maybe, just maybe, the grounds are being set for a switch back into the cheap emerging markets. We'll explore that. But we're not out of the woods yet. You see, the problem is this. Growth has very little to do with corporate sales. And when we look at corporate sales in Japan, the US and Europe, they are flat. Corporate sales are flat. So if corporate sales are flat, how come profits in the US are rising very strongly? They can only do that by cutting costs. And American companies don't have much fat left to cut. And margins are already very high. And so there's still a big question mark over US equity earnings. And if there's any faults in those this year, if the forecasts aren't met, you could very easily see market resistance. And we'll come back and highlight that in a minute. When you look at Asia, well, it's slightly different, because even though profits growth is starting to pick up, Asian sales, corporate sales, have been doing this. They've been very, very strong. So why weren't profits stronger? So again, a question mark over Asian earnings. But thankfully, that's starting to swing back. If this continues to rise, the case for moving into Asia again also rises. And the place where you probably believe the earnings forecasts more than others is Europe. Europe profits have fallen along with slow and sluggish sales. So you believe it. So it comes down to value. Is this being valued out? Is there any chance for profits growth to rise again? And it doesn't look so. So we still see good value in Europe, but we see selective value in Europe. We've made a lot of money out of some of the Italian stocks last year in some of our funds, and we're positioned quite aggressively in specific European markets, but not Europe as a whole. Now, I want to pick up on these themes later on, and you'll see why when we start to talk about valuations. All right. So, let's sit back and look at what the markets did last year. We've had a lot of noise. We had a fire drill for tapering. Let's see how the markets actually reacted. And if we look at treasuries, global treasuries, well, they sold off a little bit, not much, bottomed out, and they've been trying to recoup ground lost. Because of the liquidity. A lot of liquidity out there. They may be expensive, but they could get more expensive if the returns are real. When we look at commodities, it's signaling stable growth. When we look at gold, it's fluctuating along with sentiment as people get scared and then worry that the growth is going to stall, so they go back into gold. Oh no, growth isn't stalling, get out of gold. I'd be very surprised if gold doesn't fall again. The real interesting one is, look at investment grade bonds. Yes, they sold off a little bit, but they've held up well. And it's more than just Fed tapering. Oh, the Fed's tapering, the Fed's not tapering. It's a convenient excuse, in my opinion. Ditto when it looks at high yields. I'm sorry, the green doesn't really show up there. In fact, it's not actually green. I don't know why it's appearing green here, but that's high yields. So high yields have actually come back. And when we look at equities, worldwide equities have got more volatile, but they've continued to rise. And of course, a lot of this has been driven by the developed markets, which have got question marks over their earnings, and the sales, corporate sales, are flat. So when you look at Asian markets, you've got to say, why on earth are Asian markets performing like this when we've not only got better growth, we've actually got better corporate sales? So profits can rise because of growth, not because of cost cutting. If the valuations, or as the valuations of the developed markets get higher and higher, I would be very surprised if we don't start to see a switch towards some of the cheaper emerging markets again, because people are chasing growth. It will happen one day. We also heard a lot about money leaving Asia. Well, let's have a look at this. Let's have a look at what the Asian stock markets did last year, i.e. 2013. We got the fallers, and yes, some markets fell. The Philippines took an awful hit. But look at it. It was one of the few markets in the region that was actually rallying. It was up over 25% before it sold off. A market rises 25% in 5 months to become the most expensive market in the world, and it sells off. Where's the surprise? If it hadn't been tapering, it would have been because President Aquino woke up with a hangover one morning. It would have been something. And when you look at the other markets that sold off, Indonesia, or Thailand in this case, same story, had a good rally. And of course, Indonesia had a good rally. You notice that I didn't mention one market that everybody was talking about, which was the Indian market. And when you look at the Indian market, big deal. India's been trading around a band all year. It was just another sell-off in a trading market. That was all. When we look at Taiwan, same story. When you look at Hong Kong, same story. When you look at Singapore, same story. Markets trading around a band. And you certainly didn't hear about these markets. in the third quarter, when everybody was talking about tapering fears. You never heard about the strong rally in Korea. You never heard about the strong bounce back in China. You see, there's other factors at play here. Now, the eagle eye amongst you will have noticed that I've not got Malaysia in there. Yes, but I know you know what the Malaysian market did, and we're going to talk about Malaysia later on, but Malaysia was in up here. The outflow of funds from Asia. Money has flowed out of Asia. Well, yeah, maybe. This is the net foreign purchases of Asian equities. And you can see, yes, a little bit of money flowed out of India. A bit of money certainly flowed out of Indonesia. It's debatable in Korea. You know, it's so close to... Look at the Philippines. Despite being the most expensive market in Asia, money is still flooding into the Philippines. Why? Because people are clearly buying the growth story. They're buying the re-rating story. They're buying the structural story. People aren't buying a one-year story. They're buying a 20-year story. Now, of course, this might get hit because of the typhoon and the effects that's going to have on growth, but that's an external factor. Without that, people are still buying the underlying growth story. Look at Taiwan. Money flooding into Taiwan. And with Thailand, people are trying to make their minds up. But to say that money was flooding out of Asia or Asian equities is just plain wrong. We saw indices sell off, we saw traders mark down prices, but we certainly didn't see the money flood out. If sentiment does change, as one of our fund managers is concerned about, if sentiment does change, then there's an awful lot of money that could flood out, but it doesn't look as though we're in that position. The currencies have a similar picture. When you look at the NT dollar, when you look at the Singapore dollar, the NT dollar, in actual fact the RMB should have been in there as well, these currencies all hit up. We saw a little bit of an outflow in Thailand and Malaysia because, of course, people got worried that there might be a current account deficit appearing, and if the Fed is tapering, there's not going to be enough money to fuel that current account deficit if it appears, and then that quickly bounced back. The two currencies that really did get hit are the Indian rupee and Indonesia's rupiah, because both economies have current account deficits that look as though they're going to continue, and if the liquidity dries up, then of course they've got a problem finding the money to fund those current account deficits. But if there's plenty of liquidity out there this year, as we've seen, then maybe this will bounce back. Our take is this. On our calculations, India, which is up here, India, we saw the bounce back. India, the Indian rupee, is now, today, a very cheap currency. And the Indian equity market looks attractively valued. So for investors, we are saying to them, look, maybe you should be thinking about bottom fishing, because you've got a cheap currency, you've got a cheap stock market, so maybe you should be bottom fishing. Be aware that if the trade figures deteriorate, you could see the currency weaken again, but if you really are an investor and you're investing for a 2 to 3 year time horizon, bottom fishing looks very attractive in India. The difference is, with Indonesia, the rupiah still looks quite expensive. And so unless the Indonesians manage to improve the trade balance, then the risk of further downward pressure on the rupiah remains. So even though equities in Indonesia look attractive still, they're certainly not as expensive as they were. We'll see in a moment, they're still quite attractive. For an external investor, there is a currency risk. So where the rupiah goes will depend very much on where those trade figures go. And at the moment, the jury is still out, which is why the government is having to raise interest rates in order to reduce the level of imports. So we're watching the volume of exports in Indonesia very, 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 very closely. And of course, the last currency, the Korean won. And look at the difference. The Korean won has a huge current account surplus, and people have started to buy the Korean story as a proxy for the US recovery. If US equities are starting to look expensive, then people are saying maybe we should buy the proxy on the US recovery, which is Korea. And a couple of our funds are actually buying Korea for that very reason. So, what does this mean for the individual asset classes, and what are the strategies that we can follow as investors this year? Well, if we look at bonds, you can see that US Treasuries are expensive. They rallied here, they sold off, but they just sold off back to first base, back to where they'd come from. And of course, they're now starting to rally again. So this is not a sign of the big rotation from bonds into equities. We think we're still a long way from that day, the big rotation from bonds into equities. We've had a fire drill, no doubt about that, and that will alter investment patterns going forward, but certainly not the beginning of the big rotation from bonds. When we look at US investment grades, we get exactly the same picture. Here we are. Now, given the spread between these two, it seems very unlikely that US investment grades are going to rally much this year. So most of the income will come from the coupon, from the bond coupon. People can buy bonds, investment grades still for income, if that's what they want. When you look at Asian corporate bonds, though, when you see that they were trading very, very similarly to the US counterparts, and then because of the crisis, Asian companies got hit worst, and yet they're in a very strong position. So 2014 could be a year in which we see a switch from US investment grade into Asian investment grade bonds. I'm not saying it will happen, I'm saying the conditions are there for this to take place, and it is, if an investor is investing in high investment grade for income, then they can get a higher income in similar rated companies in Asia. That's attractive, especially if you think interest rates will remain low for a long time. When you look at US high yields, exactly the same picture, only more so. When you look at Asian high yields, exactly the same as well. In fact, Asian high yields are well off their lows. And I think once we've seen the property cycle start to turn in China, because a lot of Asian high yields are Chinese property stocks, you could very easily see that sector start to rally quite strongly. And of course, the last one being Asian local bonds. Again, because people were worried about current account deficits, etc., all of the fundamental fears, you know them as well as I do, we did see the sell-off here, but again, people are starting to focus on those fundamentals. The fundamentals are good, so we've started to see the Asian local bonds coming back as well. There's probably a little bit more there in Asian local bonds, but again, most of the story is a carry story. So we could get a bit of spread compression and a little bit of capital gains in Asian bonds, but most of it is income. So let's focus now on equities. And while a lot of people are saying, look, we still should go into developed market equities, the question we're saying is, look, is the growth so strong in the developed markets to drive valuations higher? And we doubt it. It might occur. I don't think the rallies are over. There's still lots of liquidity there, but they are mature rallies. No doubt about it. Have a look and you'll see what I mean. This is the valuation for equities. Up here, it's expensive. In here, it's fair value. This middle dotted line is the long-term average. Down here is attractive, and down here is real cheap. And if you look at the US, there it is. It's right in line with its long-term average. Chart goes back to 1996. So again, I ask the question, do you think the recovery in the US is so strong that it can drive valuations back up to here where they were before the crisis hit, or back up to here after the recovery after 2003? It's a sort of a type of answer, isn't it? Yeah, it could, but What about Europe, that everybody loves? Same picture. Europe, the valuations are at the highest they've been, except when we've had strong recovery or strong growth in there. Is the European recovery so strong that it can drive these valuations higher? The market could still rise higher in line with the profits forecasts. If profits rise by 10%, the market goes up by 10%. That could happen, for sure. But that PE multiple expansion, you're going to have some pretty good news to drive that much further. Now, that's the developed markets. What about China? Where is China valued? Where is China valued? And it's valued here. Now you've got to ask yourself, yes, there's question marks over China, but are things in China today as bad as they were back in the 1997 Asian crisis? I think we'd all say no. Are things in China today as bad as they were in SARS in 2003? No. Are things in China today as bad as they were in 2008 when the financial crisis hit? No. So why are we pricing it as if it is? And so you see, I think what's going to happen is this. Over the course of this year, the US market and developed markets could continue. There's the liquidity to do it, and there's still the recoveries coming through, no doubt about it. Weak, but it's happening. But everything today, everything that's happened until today, suggests that people were chasing growth still, which is why they went for those markets. If that's the case, and we get some of the cheap Asian markets starting to emerge, or the valuations look attractive relatively as the developed attractive markets rise, then you're laying the grounds for a big switch back into specific markets. Now, do not quote me as saying this is what's going to happen, because we've seen that this story was true a year ago, it was true 2 years ago. The point is, when it does happen, and it will happen, some Asian markets have got a long way to rally. And if you want an analogy, think of Japan. Japan, the market was cheap for 3 years, and then all of a sudden Mr. Abe comes in with his Abenomics and the market goes pow through the roof. And that's what could happen with some of these Asian markets, backed as they are by real strong growth with real strong earnings, even if they are a bit more aggressive than is believable at the moment. Let's take this one step further. Cyclicals are stocks and sectors that respond to economic growth. So if the economy picks up, these stocks and companies pick up. So TV manufacturers, auto manufacturers, if times are good, you think, wow, I'm going to go out and buy a new TV. I'm going to go out and buy a new car. I'm going to go out and buy some property. I'm going to go to the bank and borrow some money so I can buy a new property. These are cyclical stocks. Times are good, the building industry starts putting up buildings and hotels, etc., etc. Cement prices go up. These are all cyclicals. Non-cyclicals, defensives, are stocks that remain the same. It doesn't matter whether it's a recession or not, you've still got to go to the doctor. So healthcare is defensive. It doesn't matter whether there's a recession or not, you've still got to eat. So food stocks, they're all defensive stocks. So even though the US market per se looked in line with its long-term average, when we look at those stocks that reflect growth, the cyclicals, look at what we get. Industrials. Yep, it looks as though the industrials have had a very good run. They were really cheap back here, really cheap. They've had a really good run. The question is the US recovery so strong that can drive those valuations higher? Look at the materials. Exactly the same thing. These are your cement stocks. Look at your banks. Yes, your banks look attractive, but Citibank looks attractive. JP Morgan looks attractive, but would you want to be buying them knowing all of these regulatory things that are happening? And yet when you look at the consumer discretionaries, look how expensive they are. Very expensive. Very difficult to see valuations rising higher. Now have a look at the same stocks in China. Industrials, way down here in the cheap area. Materials, way down here in the attractive area. Consumer discretionary in the attractive area. And we're all worried about the shadow banking system in China and the non-performing loans, etc., etc., etc. But look at where they're valued. How cheap do they have to get? And within Asia itself, we can see the grounds for a huge switch into the cyclical stocks. These are, again, the non-cyclical stocks, the consumer staples, services, healthcare, etc. Look at the valuations up here. In 2012, everybody got worried about growth, so they drove those valuations even higher. And they deserted the cyclicals. So the gap between the two now is very, very wide. At some point, something will trigger a switch from here back into here. And this is very important for our funds, because a lot of our funds are very heavily biased towards these cyclicals. Moreover, many of the investors over the last year that have been going into these non-cyclicals were going in for income. Well, if people are still chasing income, the income these days is to be found here rather than here. The utilities and the telecoms still give a higher yield of 3.4%, but for cyclicals as a whole, you can get a yield of 2.6% against a lower yield for the non-cyclicals, and for the non-cyclicals, excluding telecoms and utilities, you can only get 1.4%. So even if you are chasing income, the situation today is still better with the cyclicals. So it wouldn't surprise us to see that switch occur this year. But again, also, because interest rates could remain lower for longer, dividends are still in play. And you can see the power of dividends and the compounding effect here. If I take my Far East ex-Japan index and I just take it with all of the dividends reinvested, that's what I get. But if I take those companies and those stocks with high dividends and reinvest them, that's what I get. So the dividend story is by no means dead. And dividends in Asia looks to be very attractive coming into 2014 still. So let's just wrap this up by looking at some of the Asian markets. As you can see, I've talked a lot about China, don't want to talk too much more about that, but a lot of these Asian markets remain very attractive. India is attractive, Hong Kong is attractive, Korea remains attractive, here we are, Singapore sort of in the middle, Taiwan in the middle. The expensive markets tend to be the ASEAN markets. And yet, as we pointed out before, even though the Philippines is one of the most expensive markets in the world, people are still buying the fundamental growth story. And that applies to Malaysia as well. People are not buying the story tomorrow. They're buying the longer term story. That's what people are very clearly buying. And even in Malaysia, we know that there's a lot of investment in the pipeline that's yet to come on stream, which could attract people and attract investors, just as it is in the Philippines and elsewhere, and Indonesia. So these stories are not dead by a long way. And so when people say to me about the flood of money from Asia, I say, hang on. I'm not sure that I actually agree with you. Liquidity this year is definitely going to add to volatility. No doubt about it. But at the same time, I think that volatility is going to be throwing up opportunity. And just to very gently wrap it up, for our agents, we give some scenarios, which is just very, very broad case. First case, it's really, really gloomy out there. The political concerns in the US cause problems. China's growth really does slow, etc., etc. In which case, it's just got to be a plain bond story. The chances of that happening, we think, are very slim. We put 10%, but we get that 10% by getting the finger, licking it, and putting it out the window to see which way the wind is blowing. That's how accurate it is. Again, the best case scenario, same as it was at the beginning of the year. Everything is beautiful, it's calm, it's a lovely day. The children have slept in, you've had a good night's sleep. Every man finds his perfect woman, every woman finds her perfect man. You know, everything's perfect. Except, if it's that perfect, the Fed is going to say, we're going to raise interest rates. In which case, you don't want to be anywhere near bonds. And you want to be in equities, particularly aggressive type equities. The most likely case, we think, is this. High probability, where we're more or less continuing the way we are. Everything's sort of coming along okay, hunky-dory. The Feds, the US fiscal fights don't derail. Profits come in more or less as forecast. And if that's the case, you can still follow two paths. You can either say, I want to be cautious about this and take some bonds, investment grade bonds, US dollar bonds, US equities, selected Europe, and play Asia via the high dividend. So you can see we've still got a huge income theme here. But there are other clients who are going to want to say, no, I want to be positioned aggressively and go in for the aggressive companies and position myself, because I don't want to be like investors in Japan where if you weren't there, you missed it. And there will be investors that want to do that, who will go into Asian cyclical markets, who will be going into the cyclical sectors, who will be going into the peripheral Europe because things are slowly coming better, and who will be playing the high yield type stocks. So that is very aggressive. So to wrap all of this up, I think there's money to be made in 2014. I think there's no doubt about it. I think the bond story has still to go, and while people are concerned about the dividend story, or has the dividend story run its way out, I'm not sure that that's the case. In fact, I'm sure dividends are very much in play as long as interest rates remain low, and I think they will remain low for some time. I think the European markets could continue to rally under their own momentum and the liquidity, but the stress, the valuation stress signs are becoming increasingly apparent, while at the same time, particularly as you see developments in China, it's making it much more difficult to justify the low valuations there. So it wouldn't surprise me to see see a switch this year between the developed markets into some of the emerging markets specifically. And if I get this wrong, ladies and gentlemen, if anybody of you come up to me and say, look, do you remember that seminar you gave in November in KL? I will say, nope, no recollection of it. Thank you very much.